Fools, one of the biggest decisions every homeowner has to make is what kind of mortgage they're going to get, because the decision that you make is one you're going to have to live with for years to come and has a huge impact on the affordability of your home, whether you're able to make ends meet in your personal finances. My name's Dan Caplinger. I'm the Motley Fool's Director of Investment Planning, and today I want to take a look at why a 30-year mortgage might be a better choice than a 15-year mortgage, even when a 15-year mortgage might have a lower interest rate. Now, basically, when it comes to mortgages, most people go with the 30-year mortgage, and the reason is pretty simple. The payments are much lower than on a 15-year mortgage, even though interest rates on 30 years are usually quite a bit higher, as much as a full percentage point higher in some cases. The opportunity to be able to spread those payments out over twice as long a period reduces the monthly amount that you're going to have to pay. And that's a very important consideration for a lot of people. Now, even if you could afford the higher payment under a 15-year, though, it may still make sense to get the 30-year for a number of reasons. One is it gives you more financial flexibility. You can always make a larger payment on a 30-year mortgage. It'll help you get your mortgage paid off faster. But having that 30-year mortgage gives you the opportunity to cut back to the smaller 30-year monthly mortgage payment and therefore give yourself the flexibility to deal with unanticipated difficulties. Now, in addition, we've started to see banks get more tight-fisted as far as giving mortgage loans is concerned. And so if you're going to a company like Wells Fargo, like Bank of America, or like a smaller regional bank, they may actually want you to have more financial stability in order to take out a mortgage. And that 30-year mortgage with the lower monthly payments is going to make you look more attractive from a borrowing standpoint, because the amount of your monthly payment won't represent as high a percentage of your income. Now, third and finally, what the ability to get a 30-year mortgage does that a 15-year mortgage might not is it frees up your cash flow to do other things with some of your monthly income. For instance, it gives you more money to put towards your retirement in a 401k plan or an IRA. It gives you longer to invest money in the market and get higher returns than perhaps you're paying in mortgage interest. And over the course of 30 years, a lot of people find that keeping their money borrowed on their mortgage, but then investing their spare cash ends up giving them more than if they had paid off their mortgage more quickly. And so it's definitely something to keep in mind, that just because getting your mortgage paid off faster might sound like a good thing doesn't necessarily mean you might not end up better off with taking a longer mortgage. Now, for more on managing your finances, be sure to stay tuned to Fool.com for more tips. Thanks for watching, and Fool on.